Hi, guys. Welcome to the How I Raised It podcast, the show where we get an inside look at how real entrepreneurs and VCs raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Woodie Neiss of Crowdfund Capital Advisors. As you can probably guess, this episode goes deep into all things crowdfunding. We talk about the different types of crowdfunding, such as rewards based, equity based, donation based, etc., as well as the differences between Reg CF versus Reg D versus Reg A. We discussed some of the leading platforms founders can use to raise capital, as well as some surprising insider tips for running a successful raise. If you're tuning into this podcast to learn how to raise capital for your business, be sure to check out Foundersuite.com if you're a startup or FundingStack.com if you're a VC or advisor. Both platforms will give you access to an awesome collection of tools for raising capital, including a massive investor database, a new Get Intro tool to get warm intros to investors, a CRM to manage your raise, a virtual data room to run due diligence, plus pitch deck hosting, investor updates, email tools, and much more. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Woodie.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com and FundingStack.com. Today I have Woodie Neiss of Crowdfund Capital Advisors coming to us from Denver. How's your day going?
Great. Thank you very much for having me. I'm excited to be here.
Likewise, you were at Boulder Startup Week last week. How'd that go?
It was great. It's always fascinating to be around a bunch of entrepreneurs that are looking to raise capital. I think that event is interesting in itself because I think it attracts, a bolder type of venture capital cohort as well. So it's a good mix of both, people that have money and people that need money.
What kind of startups were you seeing in Boulder? We were sponsors of that, but I didn't go to it, so I didn't get to, press the flesh and meet folks. What kind of startups were you seeing there?
We only spoke to a couple of them. They were all tech related or software, I should say. But really tech, software solutions for different type of, problems that exist in the marketplace.
Yeah,
But
interesting. Well, I'm glad that was a good event. What is Crowdfund Capital Advisors?
we are a consulting and advisory firm that helps entrepreneurs raise money through investment crowdfunding, helps investors deploy capital to startups that are looking to raise money through investment crowdfunding, and helps policymakers, economic development offices, regulators understand why we need to support startups and small businesses in terms of job creation and economic stimulus.
Awesome. So is your primary customer a startup looking to go raise capital on crowdfunding platform?
I would say it's split. It's
Mhm.
between the startups looking to raise money on these crowdfunding platforms and investors looking at trying to understand how do they find these deals, what makes for the right deal, and how do they deploy capital into these companies.
It makes sense. I can understand why a startup would hire anyone, an advisor to help them figure out crowdfunding because it's not quite as simple as we'll get into that. That's quite as simple as it looks. Why would an investor, I mean, can't an investor just go and get on these crowdfunding and kind of pick and choose things that like resonate with them?
Love that question. Yes, they can. The problem is nobody has time to sit there and throw a net out into a pond and go fishing for a bunch of different startups. In April, there were 650 active offerings on probably 35 different platforms.
Mm.
So if you're an investor, you're going to have to be scrolling through all those different platforms, all those active offerings to find the deals that relate to what you're looking for. That's why we built this product called Capital Pulse. What we did is, we've got about 10 million data points related to every offering that's raised money through investment crowdfunding. We built a database called C-Clear that aggregates information from all the platforms, all the companies raising money, daily transactions, so the amount that's being committed to these offerings and the number of checks. And we built an algorithm that is sort of machine learning. So it constantly takes in new data, spits off old data, and then it quantifies what we think are signals in the data set for companies that are going to go on for a follow-on round of financing. So clearly they're hitting milestones, revenue targets, whatever. They're going out for small rounds raising money, achieving those goals, and going out for another one. So with Capital Pulse, we've sort of consolidated that down into a weekly list that we send to investors. And it helps them really narrow their focus on where we think they should be looking at opportunities without having to spend hours and hours going through all the offerings out there.
Yeah, it makes sense. Is that a subscription product or is that do you take a
Yes.
little
Yeah,
fee?
it's a subscription product. Yeah.
That makes sense. Cool. What's your backstory? How'd you get into this business? How'd you, get into the crowdfunding, presumably kind of at its
Yeah.
early days? Yeah, go.
So I started on Wall Street. I worked on the trading floor for PaineWebber before it was UBS on the government trading desk. So we dealt in bonds. Went to the retail side and moved out to California. Worked there. Realized that wasn't my career calling. Went to work for a Silicon Valley software company called PeopleSoft. They are a database company. I learned all about databases. I had my MBA, so they were flying me around the world to meet with Fortune 500 CFOs. And I learned about hyper-growth venture-backed companies just by working for them and what VCs were looking for in terms of their investments. Of course, PeopleSoft went on to be acquired by Oracle for quite a large sum, but I learned a ton. I left PeopleSoft, started my own healthcare technology company called Flavor RX. We flavored medicines for children so they're more compliant. People can go into a pharmacy and choose whatever flavor they want their medicine to come in. And this is where the idea for crowdfunding or investment crowdfunding really started, because I would get calls from mothers after they got their kids to take medicine and be like, listen, my kid hated amoxicillin or by accident. They just spit it up. But your product worked. And this is the first time in history. How do I invest in your company? And I'd be like, well, you can't. There's these laws that were written in 1933 to protect investors like you from investing in companies like ours. Only rich people can invest. People were very upset when I said that. And I said, it's going to take, a change to the securities laws. So when we sold Flavor X to a private equity group in 2007, I sat down with two of my friends from Silicon Valley who had their own startups that were VC funded. And we all agreed this method of raising money from VCs it's exclusive. It's exclusionary, it's luck of the draw, and things at the time. And we live on the internet now. We should be able to update the securities laws to the internet age. So we wrote an 8 bullet point framework. We socialized it with our friends on Sand Hill Road, which is out in Silicon Valley where all the VCs are. And we wanted to know certain things. At what point will we be stepping on your toes if we legalize investment-based crowdfunding? And that's what we came up with the $1 million cap. And we presented it to the SEC. They thought it was cute. They said, we don't write laws. You're going to have to go over to that building with a white dome. We walked over there and literally just started walking the halls of Congress. This might have been the last time Congress worked together, but this was a very bipartisan legislation. It passed the House 407-17. It went over the Senate, passed 73-26, and we got to go to the White House. As the president signed it into law, he said what we did was game changing. We did it in 460 days, and it launched this entire industry that is now a $3 billion industry that over 8,300 companies have used to raise, capital in over 2,300 cities across the United States.
Wow. What year was that, or what time frame was that?
So we worked on the legislation in 2010. It was signed into law in 2012. It took the SEC 4 years to come up with the rules related to it. They weren't the commissioner, the SEC chair at the time when it passed was not a fan of what we were doing. So she refused to put this on her plate for the rulemaking. However, the rules were done 8 months after the president signed it into law. We just had to wait for a new SEC chair to come in. But in 2016, the industry went live. And so, we're a solid 8+ years into it now.
And just to summarize, was obviously a lot of work. That was the passage of the
Jobs Act.
The Jobs Act, which summarize it. It gives startups the ability to raise. Maybe just give me a quick summary. I don't want to guess
Sure,
that.
yeah. So, there were 7 different components of the Jobs Act. We were Title III. But what it allows is any startup or small business can raise up to, now it's 5 million. When it first passed, it was 1 million from any American. So you don't have to be accredited. You can be just your average Joe American that's a customer of one of these companies that that customer actually believes in. And you can do what's known as general solicitation. So before, this went into effect, it was a very closed door conversation that you had to have with people that you had a relationship with. And that's one of the reasons what made it so hard. Now, however, you can go onto these platforms that are registered with the SEC and overseen by FINRA. These platforms are really websites, but on these websites, you can post your offering, tell people what you do, put a nice video up there about the problem that you're solving, and invite people to invest in your company. It can be either debt or equity. If it's debt, it's a great opportunity for investors because the average yield right now is about 10%. Default rates for debt offerings, crowdfunding offerings are very low. Turns out that entrepreneurs don't want to let their customers down, much unlike they're willing to let a bank down. And so the repayment rates are very high. They're on time. The yields are great. And then on the equity side, people are issuing stock in their companies and making everyone like little VCs. And so they're investing in these businesses at their earliest stages. So it is risky, but you have to look for, smart teams, people that have really strong patents or IP around their technology, have a moat, and are showing traction in the area that they're focused on.
Yeah. So to summarize that though, it allows you as a startup to raise up to 5 million from any American and do general solicitation. That's the basic version of equity crowdfunding, right? I mean, is that correct? That's Reg CF. I don't want to get too deep into the weeds, but I want to paint enough of a picture to give people kind of the basic frameworks. Is that correct?
It's Reg CF, but you do have to do disclosures. So you need to have a business plan. You need to have a use of proceeds. You need to have a valuation and how you came to it. So there is work that needs to be done, but that's all part of this process. It's a regulated way of raising capital.
And, I know there's rewards-based crowdfunding, there's debt, there's equity. Under the equity portion, maybe if you're willing, give a high-level review of Reg CF versus Reg A plus versus Reg D. Just in as simple terms as possible. I'm sure there's many nuances, but just
right.
Yeah, go for it.
Reg D is your traditional way of raising capital before the Jobs Act came into effect. You can raise an unlimited amount of money from as many accredited investors as you'd like. Those investors need to self-certify that they are essentially wealthy. You can have up to 35 unaccredited investors, but the lawyers don't like any of the entrepreneurs to raise money from unaccredited investors on their cap table. No general solicitation. So this all has to be through relationships behind closed doors. You can't publicly post that you're raising capital. It's all behind the scenes. Reg CF allows you to raise up to 5 million online on these funding platforms that are registered with the SEC and overseen by FINRA. You can have both retail and accredited investors, and you can do general solicitation. And so it allows you just a broad access to individuals. Reg A is a qualified offering with the SEC. So what that means is you can raise up to $75 million through Reg A, but you're going to file a prospectus with the SEC. That prospectus is going to have a couple hundred pages of detail about your company, what you're doing, all your audited financials, a lot of legalese in there. So you're going to have lawyers working on this. It's going to cost you probably $100,000 to put that together and to answer the questions from the SEC. The SEC isn't approving your offering when they qualify it. They're just saying you've answered all the questions that they believe investors need to have access to in order to make an informed decision. But a Reg A, so Reg CF is great for smaller companies, startups, that are just scaling. And right now we're seeing that most of these companies are post-revenue. Average revenue is about $1 million. And they need to raise, up to 5. Reg D is great for hyper growth, like sort of venture-backed companies where they've got access to those VCs or angels and can raise, larger sums of money. I would tell you that a lot of companies graduate from Reg CF to a Reg D. And then, other companies are much larger ones are going for Reg A. A lot of real estate funds use Reg A as well. Raise money from investors to invest in real estate deals. But, they're going to be much bigger companies.
Yeah, interesting. Okay, so for most people listening, Reg CF is going to be the one to investigate if you're doing equity-based crowdfunding, and that's up to $5 million. any American, accredited or unaccredited, and it does allow general solicitation. Do I have my basic facts correct?
You did a great job.
Okay. It's funny because it does get a little confusing. And just
Oh,
for
yeah.
anyone who's totally fresh or new at this, when we talk about accredited, that means the investor has a certain amount of assets, maybe define accredited, just, so get that out
Yeah,
of the way.
it's a definition defined by our government
Yep.
that says that if you make, I think, over $250,000 a year for the past 2 years, or $350,000 with a spouse, or you have a net worth outside of the equity in your home of $1 million, you are considered accredited, which means that you are wealthy enough to make risky decisions.
Yeah. And general solicitation, you already talked about this, but basically, it means you can kind of promote this to anyone, which applies to Reg CF, right?
That is correct. And
Okay.
there is part of Reg D. It's called, the traditional way was 506B that allows you to raise money behind closed doors from accredited investors in an unlimited amount. There's now 506C, and it allows you to do general solicitation and raise money from accredited investors. But the difference is you now, as the entrepreneur, need to certify that your investors are accredited. So you need to have those investors provide documentation, either tax forms, investment statements, or a letter from a CPA or an attorney stating that that investor is accredited before you can actually take their investment under 506C.
Gotcha. Okay. Very interesting. My little claim to fame on crowdfunding is I helped the Kickstarter guys write their very first business plan a million years ago. This is
That's
in
amazing. I love
the
that.
forever ago. And it's fun to see this whole industry, but I haven't really been too close to it since then. Um, yeah, Perry was fun to work with. So let's talk about this in a few more ways here. I mean, under the framework of crowdfunding, we've got our equity crowdfunding, which we just went through, Reg CF, Reg D, Reg A. You also have rewards-based fund crowdfunding. And what else am I forgetting? What other types of crowdfunding?
Donation. So
Donation.
GoFundMe is like donation crowdfunding. Indiegogo and Kickstarter is rewards-based crowdfunding. WeFunder, Start Engine is your equity type of crowdfunding, and Honeycomb or SMBX are your debt type of crowdfunding.
For most startups, I guess it depends on the type of startup, but are folks, if I have a startup building an interesting, call it fintech or SaaS, would I look at rewards-based platforms, or am I really just gravitating probably towards equity or maybe later a debt platform?
I mean, in the past, I think you would look at rewards-based crowdfunding. If you had a prototype of a product like that Oculus goggles that was bought by Facebook for $2 billion, this was a great way for you to test the marketplace and prove that there's traction in the market for your product or service. That's still an opportunity out there. Things have changed a little in the sense that once Oculus made $2 billion from that sale, and all those people that backed that offering without owning any equity got nothing. They were a little irritated. And so now you've got to be cautious about, using the to validate your product without giving them anything in return, because it could cause backlash. Now, the flip side of it is now that equity crowdfunding's here, if you've got a product that you believe has this opportunity to be acquired by a company by like Facebook, it's a great way for you to do both. You can actually let people pre-order your product on a Kickstarter campaign. You can actually do an equity offering, say, if you invest X number of dollars in our company, we'll give you one of these products. So now you're turning them from customers into investors, doing both. And then when you have that liquidity event, they actually benefit from the upside and actually helping prove that you were worthy of that.
So it's a little bit blurring the lines a bit if I'm hearing what you're saying, right? I mean, you might be offering some rewards, like here's an early version of our product, you get it before anyone else. But if you invest a certain amount, you also get equity in the company. Is that correct? So kind of a hybrid?
Yep, yep, yeah.
Yeah.
There might be like if you invest $10, you just get to support us. But depending on what there's a company that we just invested in called Neiss of Crowdfund. And it's to prevent, it helps with nosebleeds. And you would be like, well, why don't you just use tissue for that? Well, nurses at schools don't necessarily like to be touching all the bloody noses. If you're at a theme park, they don't necessarily want their employees touching bloody noses. And they actually have this medicinal part of it that actually helps slow down the bleeding and all that stuff. And so they're selling these products now all across the United States. If you invested in Neiss of Clip, you actually, depending on how much you invested at, will get a pack of these clips for yourself. And so, through our venture arm, we invested in them, and I'm still waiting for my 20 nasal clips to come, but I'm super excited for when they do come, and my son has a bloody nose.
Yeah, funny. Interesting. Wow. Okay. Well, let's talk about, I guess this is a pretty big question, but I'll throw it out there. How do you kind of decide, I think you mentioned 35 plus platforms out there, right? I'm sure that's 35 main ones, probably a few smaller ones and specialty ones, but how do you kind of decide where to go?
Well, I'll tell you, that was 35 active platforms in April. There's been over 150 platforms that are registered with the SEC and FINRA. So every month you've got ones that are the same ones, but there's ones that are active that month, not active the next month. So you're right. It's very difficult to know what's going on out there. We created this report called the Capital Pulse Report that allows people to essentially subscribe to this and then see, where the deals are, what we think are the hot deals that people should be looking at, deals that are getting a lot of traction, deals that are getting a lot of checks, deals where we're seeing them hit milestones. So that's one area that you can look at, or you could just go on websites like WeFunder, Kickstarter, WeFunder or Start Engine or Republic, and just start searching through the deals that are on those websites.
And just kind of get a vibe from it. Like, hey, I'm seeing a bunch of fintech or SaaS startups on this platform. That's what I do. So therefore, this should be a good watering hole for me, kind of.
Exactly. Well, and if you're an entrepreneur that is looking at this, I would definitely tell you to do that. But we have, this product called the Offering Insight Report. So when you raise capital through regulation crowdfunding, you're going to fill out a form called Form C with the SEC. And that Form C has a bunch of data fields that you'll complete. We actually recreated that form. People can complete it and submit it to us. We run it through the algorithm that we created. And it shows people, based on what industry you're in, what your revenues are, what platform we think is right for you, how much we think you can expect to raise, where your valuation should be. So we answer a bunch of the questions that you probably have about, is this right for me? And how much can I expect to raise through the Offering Insight Report?
But in general, like when I think about if you're again, my knowledge is one tiny fraction of what yours is, but if someone said, I'm making a consumer product, I'd probably say go look at Kickstarter, Indiegogo. If I'm making, a more tech-focused product, kind of looking at, I don't know, Republic or Start Engine. Like, what are the general kind of rubrics here?
You'd be surprised, ever since we started collecting this information, there's been over 540 industry codes for companies raising money. And WeFunder and Start Engine and Republic, they do the majority of the offerings, but they've done it across many different industries. I would tell you that, companies like Republic are very crypto leaning. So a lot of companies that are working in that space are there. WeFunder, you're seeing a lot of AI related companies raising money on WeFunder. A lot of healthcare technology companies on WeFunder. Start Engine's got a lot of software related companies, but you'd be surprised, utilities and clean tech are out there where you've got companies doing solar panel installations. And so it's, you do need to pay attention to the platform type to make sure that you're targeting the right platform, because you have to think about it this way. These platforms have an audience built in. Not that all those people that have invested in a similar type of deal before will invest in yours, but that platform will be doing marketing to that audience. And so you can benefit from the right fit with the platform and your industry so that they can solicit those investors for you.
Yeah. Okay, I want to talk about that, like kind of best practices once you get on these platforms and tapping the audience they've created. But before we get there, I still have a few more questions. In terms of equity crowdfunding, you mentioned WeFunder, Start Engine, Republic. What else? What's number 4 or 5, maybe on that list to investigate?
Check out if you're a company and you don't really want to do a lot of the work related to it, and you just want to have a partner help you with it. I would tell you to look at Dealmaker or Dalmore. They're broker dealers in the space. They have teams that essentially can help you put your offering together. I think a WeFunder or Start Engine is more of a do-it-yourself type of platform where you and your team will do the majority of the work. In this space, you've got what's known as funding platforms and broker dealers, and some
Mm,
cross the line or blur the line. But the broker dealers can do a lot more than the funding platforms can, but you will pay them more in terms of a fee related to the capital that you raise. Some of them charge extra fees in terms of warrants or stock, in addition to what you're giving them in terms of cash. So, pay attention to the fees that you're going to be paying these platforms too.
gotcha. That makes sense. As the equity platforms have arisen, has that taken some of the wind out of the sails for the Kickstarters and Indiegogos, which, I think of those guys as kind of the pioneers in this space, but
Sure.
they're not so much equity, or am I wrong about that?
No, no, Kickstarter does not want to be regulated. So
Okay.
they're staying far away from equity and debt. They are purely saying you are giving money to someone, you might get a token of appreciation in return, but there is no financial interest. And that's a great space to play in because you don't have to deal with any regulators. Debt and equity crowdfunding, these platforms go through a very serious registration process with the SEC. FINRA comes in. FINRA is the one that oversees all broker dealers in the United States, and they do their diligence to make sure that you are keeping consumer records properly safe and secure, that personal identifying information doesn't get out there. So it's a completely different bucket of entity. Yeah, I mean, keep all that in mind.
Yeah. Indiegogo has crossed over into equity as well as rewards.
They did launch a equity platform, but I don't think it went anywhere, and I think they pulled back and just stuck with what they were doing right.
Yeah, interesting. That's cool. So have those guys kind of seen their deal flow? I mean, it's cool that they can avoid the regulation, but it also seems like the economics would be on the equity guys. I don't know. Yeah. What do
Yeah,
you think?
I mean, I think donation and rewards crowdfunding. I don't know the exact numbers related to that because we just focus on debt and equity. But I think they serve a niche in the marketplace, which is really pre-companies having a reason to go out and sell equity or raise debt capital online.
Okay, yeah, and I'm poking around Kickstarter. I mean, there's still deals getting funded and overfunded. Like, here's a tennis robot for real rally play. They've raised 1.3 million, so it's still happening. That's interesting. Very cool. So, all right, so let's talk about this. You're a startup. You first got to figure out if you want to do crowdfunding, then figure out maybe the platform. Do people ever do multiple platforms at once, or you really got to pick one?
We don't see necessarily multiple platforms at the same time because when you file with the SEC, you list the platform under which you're going to raise capital. But what we do see is companies that are doing multiple rounds of financing moving from one platform to another. So one company might start out on Start Engine and move to Republic and then move to WeFunder. They could just stay with Start Engine. So we do see companies moving that way. But I think, to what we talked about before, figure out which platform is right for you, and hopefully you have a good experience and you can just stick with them through the life cycle of it.
That makes sense. Can you do a Reg CF, raise 5 million bucks on, one of these start engine, call it, and then do another Reg CF 5 million on another platform, or is it like 5 million total for your company?
It's 5 million every 12 months.
Okay. Mm.
So you can raise, if you do 1 million and you close, you can go out immediately and do another raise. But one of the things that you can do to go over that $5 million cap is you could do a parallel offering. So you could do a Reg CF offering and raise up to 5 million on that, but you could have a 506C offering open at the same time and raise money from accredited investors only in that bucket and raise an unlimited amount. So a lot of times, and we track all this in our data set, we're seeing these parallel offerings happening and they're going well over the $5 million because they have both of these open offerings at the same time.
Interesting. Okay. Yeah, I mean, I'm seeing every now and then I'll see someone on our platform, which is typically for raising from angels and VCs. I'll see them doing a crowdfunding at the same time, which sounds like a lot of work because raising traditional capital, which is kind of our bread and butter, takes all your time. So I don't know how they do both, but it does happen. Okay, let's talk about best practices. All right, so you pick your platform, and I guess just stick with kind of equity crowdfunding just to keep it simple because I know there's so much variability here. But what are best practices? You pick your platform. We want to go live. What are some of the top 5 tips or top tips you give founders to make it a successful campaign? Because I see a lot of campaigns fail.
Oh yeah, yeah. I mean, a good chunk of them fail. You cannot crowdfund without a crowd. Okay. So if you think this is again going to be a fishing expedition, you're going to put an offering up there and people are just going to find your offering and invest in it, you are grossly mistaken. You need to build that community before you go out because that community will be your investors. So you need to socialize with them, build trust with them, help them understand why they should make an investment in your company even before your offering goes live. When you've decided to do one of these offerings, you need to soft circle among that crowd your desire to go out and raise capital. And you need to get about 30% of what you want to raise soft circled from them. And you need to let them know, listen, I need you within the first 48 hours of my offering going live to actually invest in the offering. And why is that important? Because nobody wants to be the first one on the dance floor. Investors are very monkey see, monkey do in many cases. They want to know who's in the deal, why they got in the deal. And so they want to see that list of people before they go in the deal. So you need to build that credibility by having all those people there. Third is get your valuation right. I cannot express this enough. A lot of companies are thinking, I'm just going to put a high valuation out there. That's a very easy way for you to fail. A lot of these people that are going to be looking at your offering are very sophisticated investors. They probably understand what your business does, the industry that you are in, and what your valuation should be. So you want to make sure you price your company based on what other people that understand it are going to, come back and say it's worth. Fourth is you need to be incredibly transparent and communicative with your investors throughout this entire process. So when you put your offering up on these web pages, there's an area at the bottom where it's got a comment section. You need to keep your eyes on that section to see what questions are coming in from investors and make sure that you are answering those questions thoroughly and on time. Because if you're not, and we see this even with our venture fund, we'll ask questions on the platform and the entrepreneur won't answer, and we'll see other people saying, hey, why don't you answer Woody's question? So you just don't want to be that company that is not transparent and forthcoming with investors because you lose credibility with them.
Yeah, those are great. Those are great. I want to touch on one of the things you mentioned. You can't crowdfund without a crowd. I feel like this is one of the, I wouldn't call it a dirty little secret, but I think there is a perception, wrongly, that you just go create a nice splashy page with some cool videos and that's going to attract investors to you. But really, the dirty little secret is that you have to bring your own audience, bring your own crowd, bring your own network. So I guess the question would be, how much of a crowd or audience do you need to bring? What do you think?
It all depends on how much you want to raise, but I would say you should probably have at least 40 people lined up that will be writing checks from $10 to 5,000 or 10,000 into your deal before it goes live, because these are the people that are going to bring, like we said, other people in. But if you look at how we are living in this world of information overload and social media, and if you pay attention to these influencers on social media, you're going to want to turn your investors into what we're calling influencers. which are influencers that are investors. So on TikTok, you see people promoting the viral Dubai chocolate, and everyone's getting it. I got it; it wasn't really that tasty. But these are when you get your investors, this community, you're going to want them on social media talking about your company, why they invested, why they think the solution that you have is the right solution, and how other people can get engaged. So, spend some time with that crowd, building that relationship and getting them accustomed to what you need them to do.
Yeah. Yeah, it's interesting. So, and you mentioned this, you kind of need to have 30% of your raise soft circled. Therefore, if you're raising $1 million, you need to have, call it 300K committed, soft circled by friends, family, fools, other people who already know you, so that when you go live, it looks like a vibrant campaign. Correct?
Exactly.
Yeah.
Exactly.
In terms of these influencers, so is there, I feel like there probably is, but is there kind of a cottage industry of, finding influencers in your space, like this tennis robot on Kickstarter, finding a tennis pro or two, giving them some equity so they become influencers? Or maybe let me ask the question a different way. How can you attract influencers to your startup as you get ready to go crowdfund? Right?
I mean, the best way to do it, which is not always the easiest, is get them to invest in the company. And then they have a vested interest in your success and want to do the outreach because they're investors in it. If you give them equity, legally, they need to disclose that they were paid for their, essentially role that they have in the company. And then it loses a little bit of the credibility that way, because then you're paying someone to say, go out there and promote my product, service, my stock. So it takes on a different sort of flavor. But
And that scenario, sorry to cut you off, but that's if you're giving Serena Williams, just to use an example, giving Serena Williams, 0.5% of my company so she promotes it is different than if she actually invests 100K and then promotes it, right?
yeah, yeah.
Mhm. Okay. Yeah, that makes sense. Cool. Other ways to attract influencers? Because I feel like, and maybe two-part question, other ways to attract influencers, and then how much is, call it the first 5 days of your campaign? How critical is that first period to get that buzz going?
I mean, attracting influencers comes down to building your crowd before you go live with your offering. So you want to be going out to those people and helping them understand the product or service, the solution that you have in the marketplace, and see if they would get behind it. That is like the key part there. I wish there was a Rolodex of, influencers we could get in touch with, but there isn't. But that to your second question, that first 5 days is critically important. You need to be out the gate and you need to be showing traction, because if it's showing zero day after day after day, no one's investing, because again, nobody wants to be the first one on the dance floor. Even if it's $100, that's not going to work. You need to show serious traction in relation to the goal. So the people that raise a lot initially, just build that momentum and keep it going.
You mentioned how important it is to get the valuation right. If I'm raising a seed round with a venture firm, I know how setting a valuation works there. It's often just figuring out how much you're trying to raise and what kind of equity percent the investor needs to get, and then backing into a valuation. How does it work in the crowdfunding world?
In the crowdfunding world, you're going to want to get comps. So you want to position your company in your industry at your age and revenue stage against other companies that are similar to yours. And you want to show investors, like, these are other companies that are not direct competitors to ours. They might be, but this is where they were or are at their revenue stage. And we match up, we align ourselves with them. And that's how you justify your valuation. You don't just want to say that, I'm a startup, I think I've got a great idea that's going to be worth $1 billion, so I want to go out with a $20 million valuation. That's a quick way to get a failed campaign.
Interesting though. So I guess your valuation, I mean, you will put it on there on your launch or your profile, right? Like, our valuation is X. It's hard to, I mean, I'm just trying to think of the comp. I'm just trying to process what you just said, because if I'm an early stage startup, I really don't have much revenue. I have a product, maybe some early traction, minimal revenue. Like, how do I really get comps to set a valuation? It's tricky.
Well, that's why we created this offering insight report, that it literally allows you to see what other companies that are similar, and many, it could be pre-revenue, but you want to see a pre-revenue company in an industry like yours that got funded. And you want to say they got funded, this is how much they raised from how many investors, and this is what the valuation was. On your offering page, where you actually have your valuation and how you came to it, you can actually talk about how you got this offering insight report and how it gave you these comps. And that way it's all data-based. You don't want to just throw a dart out there. You want to be able to say there's data to back up why we came to this logical conclusion.
It's not a safe. What's the format of the actual equity investment? Is it just literally common shares?
It's any equity instrument that the company wants. So it could
Okay.
be safe, it could be common stock, it could be convertible debt, it could be preferred stock, could be a token. There's no restrictions on the type of security issue. The
Hmm.
only restriction is investors have to hold on to this for 1 year before they can transfer it or sell it.
What am I forgetting? What am I forgetting to ask you? What other tips do you have for
Um,
startups? Anything else? I'm sure there's a lot more we could get into, but yeah.
Yeah, the putting these offerings together has become art and science. So the art is, how do you make a video that's compelling and pulls at the heartstrings? Because this is a lot of emotional selling to investors. Okay, so you need to pull them in. But the science of it is, what's the data that backs up why I should be doing the different parts of the offering? So we wrote a second book, which is this crowdfunding playbook. It's our second in the series of investors. It's just 150 pages long, but it is a step-by-step guide that entrepreneurs can use to actually put one of these offerings together. And it contains all the best practices and everything so that they know, a checklist of things that they should do before their offering goes live, while it's live, and even after it's live in terms of managing your investors.
Does anyone do it all themselves these days? I've heard of lots of different startups will hire a crowdfunding consultant to kind of package them up. Or do most people do it themselves?
I mean, it's a combination,
Yeah.
depending on how much time you have and depending on how big your team is.
Yeah.
You can put one of these together. If you don't and you just want to outsource it, there are agencies that will do it for you. I don't know if those agencies necessarily have all winning offerings because it comes down to your crowd. So they can help put together a very compelling offering. But if you don't have the people to do the investing, their job's not to bring in the investors. Their job is to make you look good.
Yeah, right. Makes sense. What are the downsides? I mean, I think like I kind of alluded to earlier, there's this myth that you just put up a splashy issue or, page and offering and that attracts investors. As we've talked about, you need to bring your own audience. I guess what are the other downsides? I guess public failure if you don't hit your goal, right? Kind of what are the risks? Yeah.
I think one of the biggest risks is if you don't follow through in terms of your annual reporting requirements and your communication with investors. There's risks with the regulators. They might not allow you to do another round of financing through regulation crowdfunding. You have reputational risk with investors if you don't communicate with them and provide them with annual reports. And all that will backfire if you want to go out and raise angel or venture capital, because they're going to want to know who those investors are. It's very likely that they'll want to talk to the biggest ones that invested in you. And if you haven't been transparent and communicative with those investors, those VCs are not going to invest in your deal.
Yeah, that makes sense. There was previously a bit of a perception that startups that go raise crowdfunding are ones that couldn't, for whatever reason, go raise angel or VC. It was kind of a stigma like, oh, if you can't make it here, go crowdfunding, right? I think that's probably changed a bit, but I mean, it still ties to what you're saying that, VCs are going to want to talk to your biggest crowdfunding backers, right? Um,
Yeah, I mean, here's the deal. When the industry launched, people were like, "Hey, this is my industry. Like, you are not allowed to take these startups away from me." And so they put that image out there. Now, 1 in 5 deals has an angel or a VC on the cap table. 1 in 5 deals have these VCs saying, "Go out to the crowd and raise money from them," because they can do this marketing and brand advocacy for you much cheaper than us giving you tens of millions of dollars to hiring a marketing or advertising agency to do that for us. So there's a lot of benefits to having these, investors that are driven by your, return, your ability to provide a return to them on your cap table.
how about timeline? I mean, how long does it take? Let's just use a SaaS business, fintech business, how long does it take to raise $1 million? I know it depends on your crowd and many other things, but in general, how long does a crowdfunding campaign usually run for?
These offerings, yeah, they're between 45 and 90 days.
What percent of crowdfunding deals succeed or vice versa fail?
Well, that's a tough thing to say because when we wrote the legislation, we said you have to hit a minimum funding target in order to get any of the money that's sitting in escrow. We didn't realize that people were going to set artificially low funding targets in order to get whatever money that was committed to their offering.
Yeah.
So we're finding a lot of companies, and I don't like this practice at all. And I wish more companies would just be realistic with what they're trying to raise, but they're doing artificially low funding targets so that they can keep whatever capital they raise. So that drives up higher success rate, but it doesn't allow us to see true success in terms of, if you need $1 million and you need to spend $1 million to help you get to the next level, what percent of those companies are actually hitting that target there?
I guess one of the advantages of crowdfunding is, you have this fairly large, potentially fairly large audience of backers, investors that theoretically could be help marketing and promoting your business. Does that really happen in real life, or is it usually like, hey, it's the money? Here's the money, and great if they refer a friend here and there, but it's not really as much of a marketing audience, or what?
I mean, it always helps for people to bring their friends into a deal, but you can't rely on it. That's what I say. Your job is to build your crowd. You have to convert them into the investors.
Are any of these platforms really running away and outpacing the others? I mean, I hear like on the donation side, GoFundMe, that's the only one I hear about.
Yeah.
On the, equity crowdfunding, are they all of these four or five horsemen all fairly equal, or is anyone kind of pulling ahead of the pack?
They have strength in different areas. Start Engine does both Reg CF and Reg A deals, and so they can raise larger amounts. So they might be seen as bigger because they offer bigger deals. WeFunder probably does more deals and raises more money in the Reg CF space than anyone. Republic is again, they're in the token world. So anything crypto related to this, they far outpace everyone else in the space. And then you've got all your smaller platforms, and they seem to be all about the same.
I had the CEO of Patreon or Patreon on this show a couple years ago. How are they doing these days?
I have no idea.
Yeah, it was an interesting model, right? Like, and then of course, OnlyFans is that crowdfunding. We're getting into a whole different universe there.
Well, that
Never
is,
mind.
but a very different form, and it's not debt or equity.
Yeah, right. Yeah, exactly. Different rewards system on OnlyFans. We'll just leave it at that. Very interesting. Boy, I think we've covered a lot here. Any last final tips or thoughts for, specifically startups considering the crowdfunding path? Obviously, read your report and things like that. We'll talk
Yeah.
about the end, but anything else?
I mean, here's the deal. The VCs have moved upstream. Okay. If we think it's going to go back to the way it was, even 5 years ago, everyone's grossly mistaken. They want less risk, and they want to do what they do best. So this regulation crowdfunding has filled a gap, and it's only going to grow. So you should really be focused on what this is and how you can leverage it for yourself, because this is going to be the starting ground for all startups and small businesses in the future. And if you look at this as like a baseball game and, there's 9 innings to it, we're probably in the second or third inning right now. So you're not late to the game. You're past the part where we've been figuring things out. And now's the time to really benefit from where this industry's already come from.
Yeah, no, it's definitely a fascinating world. Very cool. All right, so if people want to learn more about your stuff, your crowdfund capital advisors and also Capital Pulse, give us some URLs to point them to.
I'll make it very easy. This is the book. It's called Investimers. So if you go to investimersbook.com with Investimers with an S, that'll take you to every single link that you need. So investimersbook.com.
Investomers, and just for people only listening, it's investomers.com, kind of like investors plus customers, investomers. Gotcha.
Exactly.
All right. I think I've taken enough of your time. This is lots to think about here and process. Pretty cool stuff. Anything else to promote or plug or final closing thoughts?
I think we've covered it all. If you're investors in it, check out D3 VC. That's our venture arm. But that's also on investorsbook.com. Yeah, I mean, this is the future. So jump on in.
Yeah, so you'll actually invest in kind of the best deals or best things you find on crowdfunding. Is that the situation?
Yeah, we honestly believe the future unicorns, the seeds of those companies are within this data set. And so we are actively identifying who they are. We're speaking to those companies. We're diligencing them the way VCs do. And we're investing in, our goal is 200 to 300 of these companies and aiming for 40 to 60 outliers.
Cool. All right, Woody, thank you very much. Investomers.com, check it out. And I'd love to hear you in the audience, your feedback on crowdfunding. Apart from being early with the Kickstarter guys, I haven't touched it much, kind of focused on the other stuff. So I'd love to hear how it goes. Thank you very much. Have a good rest of your day.
Thank you. I appreciate your time. Thanks, everyone. Talk to you later.